Double entry accounting. So double entry accounting is how accounting gets recorded. It's called double entry because whatever we do affects at least two accounts. Here in this picture, you see that we have what's called a T account. A T account represents a ledger account and is used to show the effects of transactions. On the left side of the account, we have the debit side, and on the right side of the account, we have the credit side. So what do debit and credit mean? Well, let's talk about that. So in some accounts, they increase on the debit side, and other accounts increase on the credit side. So for example, assets increase on the debit side. So when we have assets, we want their balance to be on the debit side, and we decrease it on the credit side. In liabilities, that's the opposite. And liabilities increase on the credit side and decreases go on the debit side. Now this takes a lot of time to remember, so don't be worried if it's something that takes you a while to get. It takes a long time to remember which side is which. Equity gets a little tricky because it says that credit increases are normal for equity accounts, but when we expand the equity accounts, that's not true for all equity accounts. Okay, and that is expenses and dividends have normal on the debit side. So stocks and revenues are normal on the credit side, but dividends and expenses are normal on the debit side. So I would keep this slide or the part in your textbook, the page in your textbook, handy for a reference on this, because this is something that you're going to be looking back and forth on for a while. It takes a while to get this done. Okay, so here we have an example of our cash account. So this is a cash T account with debit on the right side and credits on the left side. So we have increased the cash account by getting money from the owner and by having services earned and receiving cash for an account receivable. We've made payments out of the account for various expenses and the purchase of equipment. At the end of the day, we've added $36,100 to the account and taken $31,300 out of the account for a balance of $4,800. Okay. When we go through transactions, we then journal them and post them in the T accounts on their normal balance. We're going to look at the same exact transactions that we looked at in Chapter 1 when we were looking at how transactions affected the accounting equation. Except now with these transactions, we are going to be recording the journal entries for them. So when we look at transactions, we go through 4 steps. We identify the transaction by looking at the source document. Then we analyze that transaction to decide how it affects the accounting equation and which accounts it needs to be recorded to. Then we record our journal entry, and then we post that entry to the ledger. Okay, so this is an example of a journal entry in an accounting software. So we have the date of the transaction, the title of the accounts, the amount of the accounts, and then the explanation of what the transaction is for. Once we have the journal account done, then we record that into the account. So our cash account is number 101. We use reference numbers. So the reference numbers are so if we find a mistake, it is easier to go back to the reference. So if when we get done at the end of the period and our balance sheet doesn't balance, then we can say, okay, let's go back and look at our transactions, and did we record something wrong? And it helps to have those reference statements that say where you got your numbers from so you can track down mistakes. So those 4 steps: identify transactions and source documents, analyze the transaction, record the journal entry, and then post the entry. So for transaction 1, we have that we started overnight auto service on January 20th by investing $80,000 and receiving 8,000 shares of stock at $10 per share. So I'm going to come out here so I can type on this. So we have, it is January 20, and we received cash of $80,000. And common stock of $80,000. So you can see that I put cash here and then I indented the common stock. So this is normal. This indicates this account was debited and this account is credited. For transaction 2, we purchased land from the city for $52,000 in cash. So I'm going to insert a text box again so I can type up. So we have the date of January 21st. We received land. So land is an asset. We're going to debit land for $52,000. And we paid cash, so we're going to reduce cash with a credit of $52,000. Our next transaction, we purchased an old garage for $36,000. We paid $6,000 in cash and issued a 90-day note payable for the remaining $30,000 owned. Okay. So with this one, we get to do a compound journal entry, what's called a compound journal entry, and compound journal entries have more than 2 accounts. So we have the date is January 22nd. The debit is the building that we bought for $36,000. Now on this transaction, we have 2 credit accounts. So the first credit account is that we paid cash for $6,000. And the second credit account is that we have this note payable, which is a liability saying that we owe still $30,000 on that garage. So this is the journal entry for the purchase of that building. Okay, our next transaction, we purchased tools and equipment for $13,800 on account. So we have the date. Our debit is that we have tools and equipment. And the total of that is $13,800. And then our credit for this, we did not pay cash. Instead, we bought on credit, which means we now have an accounts payable. And we owe $13,800 for these tools. Transaction 5. So we sold some of those tools and equipment and they agreed to pay us. So when someone else agrees to pay us, that means we have an accounts receivable. They owe us money. So our debit is an accounts receivable. That's the asset account. They owe us $1,800. And our credit in this case is the tools and equipment, because we now have $1,800 less tools and equipment. Transaction 6, we received $600 on payment for those tools and equipment. So it's January 26th, and we received cash of $600, and we need to reduce that accounts receivable by $600. So if you remember, we reduce an asset by crediting it. We increase an asset by debiting it. The next transaction is an accounts. We paid on our accounts payable. So it's January 27th. We are reducing a liability. So we reduce a liability on the debit side. So we debit accounts payable, and we are reducing cash, which is an asset, by crediting it. Okay. Transaction 8. So in this case, we have service revenue and we received cash for it. So it is now January 31. We received cash of $2,200, and we provided service of $2,200. And then we paid expenses. So it's January 31st. We recorded operating expenses of $1,400, and we paid cash towards those expenses. So those are the journal entries for those transactions that we covered in Chapter 1.